Bull and bear markets are traditional economic indicators, while investors could enhance their investment strategies, understand market movements, and avoid market white noise such as news and pessimistic market sentiment. First of all, we need to understand that most of the asset prices appreciate when there is a bull market, whereas most of the asset prices fall in a bear market. Bull and bear markets each has 3 phases, a total of 6. At the beginning of phase 1 of a bull market, asset prices are getting very attractive. Value investors start to enter the market and buy assets that are undervalued. However, most of the market participants still yet to realize that the economy is recovering and think that the market sentiment is still pessimistic. Take the 9/11 and SARS as examples. In 2003 to 2004, the global stock markets bottomed out and the Hong Kong Seng index eventually rose from 8,300 points to 32,000 points. In phase 2, the market has already accumulated a certain amount of increase. But since the investors still remember the market crash freshly, therefore, even a slight correction could lead to a very pessimistic market sentiment. Due to heavy selling pressure, the market has a significant correction and the adjustment could reach to 40 to 70% of the accumulated growth. However, the difference between this phase and the bear market is the falling of the stock price in phase 2 of the bull market is only due to the pessimistic market sentiment, while businesses are actually profiting. Example is what happened in 2004 and 2005. The US was entering into an interest rate cycle, and China had implemented a series of macro control policies to prevent the economy from being overheated. These measures are, in the long run, good for the economic development. However, the Hong Kong Seng index still evaporated half of its accumulated increase right after. In phase 3, the investors are getting very used to the continuous rise of assets prices and forget the memories and the feelings of the crashes. Therefore, they keep on buying regardless the prices inflated to a situation that almost can be called insanity, just like year 2000 and 2007. In 2007, global housing markets were inflating insanely. While in Asia, markets had rumors that China would finally pump money to Hong Kong, so-called the Hong Kong direct train. It hadn't even started yet. The market had already fired up and accumulated a lot of increase. The Hong Kong Seng index had risen from 19,000 points to 30,000 points, while US S&P 500 rose by a staggering 15% in just 1 month and a half. It's in phase 3 where you can hear people talking about stocks everywhere. In their lunchtime, tea time, on their way to work, there are posts on forum saying that they were going to quit their jobs and focus only on stock markets instead. People seem to forget that the US subprime crisis had actually started evolving as early as 2006 and 2007. Even the US Fed implemented a rate cut to save the housing market. The investors still consider it as a positive news, which eventually led to the bubble to burst. There are 3 phases in the bear market as well, just that the situations in these 3 phases are completely opposite. In phase 1, investors couldn't sense the clues that the market is downtrending, while value investors start to sell off their assets. In phase 2, there's a sharp rebound in the market and investors only consider it as a correction to be part of the bull market. They still have optimistic views and confidence on the market. Therefore, whenever there's a rebound, they enter into the market again. In fact, this is contrary to phase 2 of the bull market. The businesses stop making profits and even losing money. Therefore, when it comes to phase 3 of the bear market, the investors who hold on to the assets will sell out the assets to recover their debts. Market sentiment becomes extremely negative and the assets values seem to reach its lowest price. But if winter comes, can spring be far behind? When the market is full of bad news, it symbolizes that another bull market is just about to begin. The ups and downs of an economic cycle could last for years. your market sentiment would definitely affect the market fluctuation in short term. But if we are able to grasp the trends of the market, the fluctuations would only create opportunities for us to buy or sell.